Today I have a very special video for you, and I have prepared more than 50 chart studies where we're gonna learn what does it take to do real price action trading, and I've compiled my best tips and tricks that I have learned after trading for over 15 years. And a lot of traders have a wrong idea about what price action is, and price action is way more than candlesticks. And so today we're gonna put everything together. We're gonna do price action analysis, we're gonna look at candlesticks, price patterns, trend lines, support and resistance. We're going to do proper wave analysis. We're going to learn everything about trend analysis. We're going to take a look at momentum analysis, and we'll put everything together in a multi-time frame approach. So let's get going. Let's start with an example of complex trend lines and some trend trading. And when we look at the higher time frame, what we can see is that the market is overall in a downtrend, and it seems like we may be establishing a new trend line here. And you can see just a few candles afterwards, the market is actually hitting the trend line. Now we have 3 touch points on the trend line, first, second, third. So now we are talking about a confirmed trend line. Also, we can see that the corrective waves are the ones that are leading into the trend line, right? And this is a very common pattern or rhythm of the market. We have the impulsive wave, the long, strong trending wave, and then the short corrective wave gets us into the trend line. Then we have an impulsive wave, which gets us below the last swing low. So you see that the impulsive waves, the trend waves, are always longer than the corrective waves. And now we are at a corrective wave again. So the market is pulling back a little bit, we are hitting the trend line, and because we are in an overall downtrend and the trend line is going down, we want to look for shorting opportunities right here. But a trend line alone is not enough. We have to look on the lower time frame, and we have to find other confluence factors. And what we see here is we have an inner trend line. We have the inner trend line connecting the low here, and you can see it lines up here and also here. And even more importantly, the 2 trend lines meet here, so they provide a very strong resistance cluster. Also, you can see I wrote here weak highs. What does it mean? You can see during this corrective phase, the market moved higher, but here the market seemed to struggle, right? The corrective wave put in a top here, and then you can see the next time the market is not able to break the top. And this occurs right at the intersection of the 2 trend lines. So a lot of things are speaking for potentially more short. It's a little bit too early to just sell right here, but we have a lot of things that speak for this trade, right? We have the higher time frame downtrend, we have the trend line, we have the potential end of the corrective wave, we have the weak highs, and we have here the intersection of the trend lines. So we want to short, we just have to wait for the market to get out of the corrective wave. We need to see some momentum. We need to see that the market is continuing into the trend direction and get out of this sideways range, which happens here. Momentum breakout candles are often, not always, but they are very often quite strong candles. A lot of pressure has been building here in the sideways range, which is then released here on a breakout. And pre-breakout, just 2-3 candles before that, you can see the market moved into the level here, bounced higher, but was rejected. So a very strong selling signal. At this point, it is reasonably safe to assume that the likelihood for more selling is much higher than more buying here to come. And you can see this is what happens afterwards. The market followed through, we moved lower a little bit, we broke through the last low, so we confirm that this is an impulsive trend wave. A little bit later, you can see this is what the scenario we looked at previously. The market makes a move, comes back into the trend line, doesn't touch it quite, makes another trend move, and now we are here at the next correction. We are hitting the trend line again. So if you want to be a trend trader, it really pays off to look for trend lines every now and then. And if you see that the corrective waves, the weak buying phases are pushing into trend lines, that could be your starting point for analysis. So now, again, we want to short. We are here at a previous support resistance area, but we can go to the lower time frame. And on the lower time frame, we see that for now, not too much. We have a potential trend line, and the market is trading currently at the trend line here, the long-term trend line. We wait a little bit, and we can see the trend line, the long-term trend line here that came from the higher time frame, is not holding. And suddenly we see a lot of selling pressure. We are breaking the trend line, and also we are breaking here below the last swing high, swing low, and again, a very strong selling sequence. We have our break and retest pattern here. Not every time when you have a breakout, it's gonna move away right away. Very often this tendency to do the retest or pullback is happening. So you often see those pullbacks into previous breakout areas. Those can be trend lines, it can also be support and resistance. And then at that point, a lot of breakout or pullback traders are actually getting short. So here would be then the ideal time to short. You are still trading into the direction of the higher time frames. You have the long-term trend line. You have the short-term trend line that is broken. It seems like you are trading into the new downtrending wave. And you can see after the pullback, the market followed through. And this is a first example of how we can use trend lines, higher and lower time frames, break and retest signals to get a better understanding of what is happening trend-wise. Let's look at trend wave ratios, because this is a very, very important aspect when it comes to understanding trending markets and also the relationship between trends and corrections. And very often in a trending context, you will see something like this. You have your strong initial push, so you have a very long trending phase going up here, obviously. And then at one point, the price will be so high that more sellers are coming in. Some of the buyers who previously bought are also considering taking profits. And then you will see that a trending phase will go over into a corrective market. So for a short amount of time, we move here against the previous uptrend. And this shows you then the corrective wave. Some traders would call it consolidation, sideways phase. And the relationship between the two, the angle, the steepness can tell us a lot. Here in the beginning, the market, the price rose quite a lot in a short amount of time, right? So the angle of the price move is quite steep. Whereas here, the corrective wave is very weak. We don't move lower too much, so there's not too much selling pressure. Yes, probably some traders are going to take profits, maybe some new sellers are going to come in, but you can see this is never enough to get the price really down. So it seems like there may still be some more buying interest left. And this is then your first starting point and the first clue that you could wait for the next buying wave, because what is often happening is that when the trend is breaking out, we're going to see something very similar to here, the first phase. And we're often going to see more buying continuation. And this would be your first signal that we're breaking out. We're breaking out of the highs, about a trend line. And then very often you'll see that the market doesn't immediately pull away, but you have a retest. In later part of this video, I will show you what a dirty retest is or a liquidity run. So make sure to stick around for that, because those retests happen in different forms and the liquidity run is one of my favorite ones. But the trading plan at this point, if you have been maybe going long here, first of all, if you are long and this is happening, it's not the greatest sign, but it's also not really against or showing any signs that your trade is not valid anymore. As long as we are staying above this channel here, I would say we are a little bit more bullish than bearish. I would hold on to the trade. If you would fall back into the range here, and if the market moves lower, cut the trade. But if you see the breakout, either add to the position or just remain in the position with more confidence. Maybe start trailing your stop loss, because the continuation about the highs is then really signaling the next uptrending leg, which happens. You can see we're breaking out, have another retest here, and then we continue higher. So those transitions are really the key for finding the best trades. Whenever a market goes from trending wave to corrective wave, look for the next breakout, look for the next continuations. That's how you then find usually the best trading opportunities, because you can see the market moves the most during trending phases. You really want to stay out when the market is pulling back. You want to stay out when the market is in a tight channel, because there's no money to be made. The market doesn't move. So wait for the breakout and then look to trade the continuation. That's where the money is made. Accumulations and distributions are very important terms and concepts when it comes to trend following, breakout, pullback trading. And when we look at a chart, you will often see that the market is going back and forth between uptrend and downtrend, right? We're going up, we're going down, we're going up, we're going down. And at the beginning of a downtrend, this is what we call a distribution. So when you have an uptrend, the uptrend is then rolling over and it is not able to continue higher. And we see signs such as lower highs, for example, any patterns. We could as well just have a regular rectangle pattern. This is what we would call a distribution. It means that here the power balance is shifting. Here we go from having more buyers to being neutral to having more sellers. So the distribution is really the tipping point between the uptrend and the downtrend. So here is where the balance shifts, and here's where suddenly the buyers withdraw and the sellers are flooding into the market. And the same is true for the opposite. The accumulation is where we go from downtrend to uptrend. And we have that here with a double bottom. You can see we have maybe a divergence here, and then the breakout. And then the chances of having more bullishness to come increases significantly. And of course, there are a lot of differences. Where do you find the best distribution accumulation? Ideally, you want to find it after an extended trending phase. So if, for example, you have something like here, we have wave 1, wave 2, wave 3, wave 4, wave 5. We complete the Elliott wave count. And here it does make sense to look for an accumulation, because when the Elliott wave count is completed, so after we have had our 5 waves, then Elliott wave suggests a reversal is more likely, and a continuation is not as likely anymore. So it does make sense to look for reversals at this point. And that is exactly what is happening here. You can see we make the retest, not a dirty retest. We're going to come to the liquidity run in a moment, but you can see we have the retest. And at this point now it's very likely to see more buying to come. We are leaving the accumulation zone. We are testing now previous highs as lows. And if we can get above this area, 852, then a continuation is very likely. And you can see this is what happens. Here's the breakout, the market moves back, and we dip back into the previous distribution. This is the initial distribution that we looked at. This is the area where the market went from buying surplus to a very strong selling market. So clearly in this area, something significant must have happened that led to the tipping balance of buyers and sellers. And what I would recommend is that when you see the market come back to such zones, it does pay off to start looking for similar activities. So what we want to do now, as the market is back into the distribution, we want to zoom in and see, can we see anything that would suggest we're going to see more selling here? And it seems like we have an exhaustion pattern. So we zoom in and you can see we have a very strong buying phase. Then here, the next buying phase is much weaker. So if you put an RSI or a stochastic here, you would have a divergence here. Then you can see we're suddenly having more selling pressure. At this point, I would be very cautious for longs, and I would be really looking for short opportunities. So you could think about trading a breakout here underneath the level, which happens here. Very strong breakout. You can see actually here's where we completed the right shoulder of the head and shoulders, the left shoulder, the head, the right shoulder. Huge breakout. If you want to have a breakout filter, or if you are interested in becoming a breakout trader, wait only for those long and strong momentum breakouts. They often signal more selling to come. If you see that the breakout is weak, the market is just crawling over the level, that's usually not such a good sign. You can see we move lower, and now we may be looking at the new start of a downtrend. This could be wave 1. Now you could see, do we get a pullback? Maybe back into the retest area, and then you could trade the continuation. So those accumulation zones are very important, and they can help you find good trading opportunities. You could use them as some type of filter. Draw them on your chart and then just wait for the market to get back to them, and then see, can you see something similar? Can you see signs of exhaustion? Can you see a reversal pattern? And if that is the case, then very often you can look for good opportunities around accumulation and distribution zones. So now we have looked at reversals, trend continuations, and getting into trades. But how do you stay in trades for the optimal amount of time? A lot of traders have problems getting out of trades too early. And for that, I would recommend get the tunnel on your charts. This is a moving average tunnel, and it is 50 period. One is applied to the high, one is applied to the low, and then you get this channel. And what will happen is that in a trending market, you will often, not always, but often see that the market is using the channel or trading on one side of the channel. So let's take a look here. We have a divergence here. You can see the market is making lower lows, but very weak. And then we have a shift in the power dynamics. Still very early. We have here a support that turns into resistance, and we are still trading below that. But it seems like we start to make higher lows. So if we get above this level, that would signal a long trend, and that could signal the change of the market structure. And what we then do is we could use the channel to trail our stop loss or to help us improve our trade management. So here, break and retest, this is where you get in, very straightforward. We have seen that many times. We have the breakout, the retest, and then the strong reaction away from it. And then you can see the trend is unfolding and it is using the tunnel for pullbacks. And as long as the market is not able to get on the opposite side of the tunnel, your trade should be good to go. And as soon as you see that the market is breaking the tunnel, that would be a very strong exit signal. And of course, that doesn't work all the time, but very often you will be able to ride trends for a long time. And you could play around with that. Sometimes the 20 works better, sometimes the 50 works better. It depends a little bit on whether you want to be a short-term or a long-term trader. And when the market breaks the tunnel, then that's often a signal that something is changing. And we can see this pattern many, many times. You have the divergence here, you have the divergence here, a triple tap, which we'll come to in a moment. A divergence, we have to move into the breakout area, retest here, and then off we go. So using the tunnel either for trend riding, but also maybe to just help you find trending phases, uptrend and downtrend. It can be a very beneficial tool, and I really like to have this on my chart. It is so important that you understand how to read trend exhaustion, because very often you will be in a trade and then the trend is slowing down and you want to make sure that you get out of the trade and not give back too many profits. And one of the most common exhaustion patterns is the divergence. I have the triple tap also, which we're going to observe after this, but let's start with the divergence. We have a very strong and long uptrend, and then the market makes a very weak high. You can see from this high to this high, there's not a big distance, right? Also, the consolidation phase is very long here actually. The market spent a lot of time moving sideways, which is also not a good signal. In an uptrend, you want to see that the market is easily making higher highs and higher lows. The corrective waves are not too long and not too deep. And here we have a 3-candle reversal. We have a strong series of buying. Then we have our deceleration. This is our pin bar. And then we have a strong bearish candle. And this 3-candle reversal is one of the best candlesticks patterns that you can find. If you want to specialize in one candlestick pattern, I would recommend this one. And then you have to understand where do you trade this in the right context. In a mature trend with a divergence, we can go to the lower time frame. This pattern here looks like this on the lower time frames. The divergence, we have the support level, we have the break and retest. We are also breaking and retesting here the 50 EMA, and you can see the market is rolling over. So at this point, it's very clear that the uptrend here is over and it seems like we are rolling over into a downtrend. So break and retest traders are either in here or maybe if you're very late here, but somewhere around here, this is where you get in. You have another retest here, maybe this time a little bit deeper, but at no point are you breaking the moving average. And that is the key here. As long as you are making lower highs and not breaking the moving average, that gives you a little bit more of a short bias. And you can see after the dirty retest, the market rolled over. Here we're breaking the moving average and then the downtrend is over. But at the core is always the divergence. You have this 3-candle pattern, which I would really recommend to study. It's very common, it's super reliable. And especially then if you have it in a multi-time frame context, where you then see the lower time frame, what does it say? Do you have patterns? Do you have break and retests? You can create a very nice trading strategy. Another trend exhaustion or reversal pattern is the triple tap. And a triple tap is 3 consecutive higher highs. And the key here is that each high is weaker. So whereas here you can see a very strong bullish phase, and compared to this high, we make a very easy higher high. Then from here to here, the distance is obviously much shorter. And then from here to here, the distance is shorter again. And also the prior corrective wave is much longer. And this is really important. If you see that suddenly corrective waves are taking longer, especially in a mature trend, that can tell you a lot. Probably more people are taking profits, especially if you see that this happens in a daily pivot point. So here you can see I activated the daily pivots, and you see the triple tap into the daily pivot. If you see that, look for reversal opportunities. This is a very, very high reliable pattern. And what I would do now is wait for the breakout out of this triangle, out of the trend line, break and retest, something like that. Here you have a few options and the market gives you a few opportunities. We have the breakout here, retest very deep. We have another breakout, retest of the trend line, breakout out of the lows, retest again. So here you have so many options to get into it and so many opportunities if you know about breakouts and retests. So at this point, you go short when you see the retest, if you're not already short. And now you have retested a lot of structures, right? We are below the trend line. this pivot held. We are below the last swing low, which is now a swing high. And now you really want to be short. And afterwards you can see we have more short to come. So the triple tap often is at the core of a reversal. So once you see the triple tap, don't immediately jump into the trade, obviously, but look for more confluence. Look for other signals that really make sense in the triple tap context. Now let's look at the liquidity run or just a very deep pullback. And here we're looking at a accumulation and distribution zone. The market was in a strong downtrend. Then the downtrend went over into a sideways phase. And when you see that a downtrend goes into a very long sideways phase, the likelihood that this is returning into a new trend wave is very low. If you see a long sideways phase, the chances that you're going to see a reversal are much higher. And here we already have a few signs of the higher lows, and the market is really pushing into this zone here. We have the breakout. Breakout traders would get in here. You can see the market is nicely moving into your favor. And what often happens is that those breakout traders are going to move their stop loss somewhere around here, break even. And this is a very easy thing to spot for the professionals. A lot of professionals will know that a lot of traders do breakout trading, and they will also know that a lot of traders move their stop loss very quickly to break even. And then very often you have those liquidity runs. The market is moving back into the stop zone. So if you get in long here or here, your stop is somewhere in this area, right? Either below the lows, maybe at the breakout area. And often you will see that the market is going for the stops. A very strong, aggressive move, by the way. Here you can see we have a lot of selling dipping into the stop zone. And then you can see we pick up a little bit buying here. We move all the way here down. Then we move higher. We make a higher low. So you can see we have the shift, lower lows, higher lows, breakout, continuation. So what is the message here? First of all, it's very important to understand the psychology and the mindset and the approach of other traders. Where will traders get into a breakout trade? Where will they have their stop loss? When will they move their stop loss? When will those breakout traders endure drawdowns? How significant is the drawdowns? When are they going to be squeezed? And then you can see the market moves deeper, and every time you see a huge push, and here again, a big push. And this is not a coincidence. There's so much liquidity down here, the stops, that every time we move lower, you can see when we hit such a stop pocket, we shoot higher. We hit a stop pocket, we shoot higher. So those are strong buying indications. And I have seen a lot of traders who eventually switch from being a breakout trader to waiting for those deep pullbacks. Because especially in the last recent years, I'm recording this in 2022, and I've been trading breakouts for way over 10 years. And I've seen the tendency to this over the last few years. Breakouts really worked well 10 years ago, 5 years ago maybe, but over the last few years, you will see that those deep pullbacks are very, very common. So if you are a breakout trader and maybe your results are suffering a little bit, look into your trades and do you see things that signal here maybe a liquidity run? Then maybe it's time to overthink your approach and maybe stop trading the breakouts and wait for the pullbacks and wait for the deep liquidity runs and then build your strategy around that. And now I have 10 more quick chart studies for you with different signals and different tips. First of all, the breakout buildup. Often you see the market is in a trend context, then you have your sideways phase. And if you see that during the sideways phase, the market keeps pushing into the same resistance and is really not able to come close to the previous low. So you can see the market is really staying so far above the previous low. That's a very strong signal. This is often a sign that there's a lot of pressure building. And often you will see that there's a huge breakout coming afterwards. This build-up, there's so much pressure being built up because this happens also in the right chart context and the higher time frame context. So we are in a big uptrend and you want to see continuations. Breakout, retest, and continuation higher. The breakout build-up is very common, not only for continuations, but you will often see it also during accumulations or distributions. Another one, stop zone. So we have here our distribution, accumulation zone. The market goes from downtrend, sideways range. Here, by the way, even this could qualify as a build-up. We move into the level, don't come close to the previous double bottom, then stay higher. We have the breakout. If you get into a breakout, where's your stop going to be? Maybe just below the breakout level. Other traders will have it below the last breakout candle, some traders below the last swing, and very conservative traders all the way below the pattern. but somewhere in here there will be a lot of stops waiting. And what you often see is that after the breakout, we make it into the breakout area, and then we push deeper into the zone. First, this push, and we have a lot of buying, right? But the market comes back, a lot of selling, and then you have strong buying. So if you see that you have a breakout area, the market is coming back, and then when the market dips into this stop zone, you see those strong impulsive buying candles. That's a very, very big tell. If you see those things, really start paying attention, get into the mindset of a breakout trader, and then look for continuations away from the stop zone. Those can be really good signals. Let's look at a flag, and this ties in with what we did in the beginning, the wave ratio. We are coming from a very strong downtrend, right? The market is selling off very strongly, and then we have a weak correction. We know that we are in a strong downtrend. We want to wait those corrective waves out. We want to look for signs of exhaustion, and then we trade the continuation, right? We wait for the breakout out of the trend line, which happens here. We move lower, we break the low, so we confirm the downtrend. We have another consolidation. We break out, retest, and move lower. So those wave ratios are so important. Do you see you have a strong bearish wave and a weak bullish wave? That tells you that the bulls are not in control, the bears are in control. That makes a continuation so much more likely. And as long as this pattern is given, the downtrend is still in play, right? We have a strong selling phase, and then the market just goes sideways. We don't even have an impulse to go up, and then the continuation downwards. So this is a really important way of analyzing trend waves and impulsive waves and really understanding the strength behind those forces and behind the actors. And this is it. This is the video about price action. I hope you learned something. I try to go way beyond what you usually hear about price action. I try to combine the most important parts. If you like this video, let me know in the comments, and then next week you will see a new video from me.